Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning, hello and welcome to Bazaar Morning Call. We're coming to you as always from the CNBC-TV18 Motilal Oswal studios. I'm Surabhi Upadhyay, with me Rima Tendulkar. And Rima, it's the final countdown, final lap 2025, 3 more trading sessions. Rima's last trading sessions in office, so to speak. But yeah, for the year. But you know what, interestingly, the news flow hasn't died down, global and local. So we have plenty to talk about.
Indeed, but you know, when you look back at 2025, it's been such a seminal year. First, there was that big drawdown in March and April post-tariffs. Then markets recovered, particularly global market. The AI trade exploded. NVIDIA became the first company to hit $5 trillion in market capitalization. We had Operation Sindoor, a record-shattering rally in precious metals. I mean, there have been so many defining moments in 2025 when you look back.
And now that you recount all of them, it looks like a very long year. I mean, some of those events have completely started to fade out, and then you realize it's all in a span of 1 year, right? So definitely eventful, to say the least. Let's get started. We, of course, have markets to navigate today as well. And actually, let's start by putting the performance. I mean, it's been a year to forget, perhaps some are going to say, or maybe it's a year filled with lessons for the Indian market. So I just want to, before we get to the cues of the day, let's just put up the tally and just map the Indian underperformance. And it's not just compared to Wall Street or compared to some Asian markets. It's kind of all pervasive. So look at the tally. So this year, the Nasdaq has been obviously the poster child for the bulls, 22.5% up. The S&P 500, because of late, the US market rally has started broadening out, and we saw signs of that on Friday as well. So the S&P 500 up about 18%. Dow's not too bad, about 15%. Look at Asia. And those Asian tigers have really been roaring. Kospi has been the defining market with a gain of about 72%. Hang Seng not too bad, about 32% on the Hang Seng. The Nikkei itself, with inflation rising in Japan, with interest rates rising in Japan, despite all of that, the equity market hasn't done bad. 30% up for Japan. Shanghai Composite, mainland China. Now, you'll argue whether it's just local Chinese money, whether it's real, genuine long-term foreign interest or not. That's a debate that goes on, but the index hasn't done bad, 21%. Look at Europe, look at, the UK markets as well. The FTSE has beaten us with a 20% gain. The DAX is up 21%. And overall, if you look at the Stoxx 600 index in Europe, that's up about 15% as well. And then comes India. 9% on the index, that's the nifty. And the broader market. Mid-cap index only 5% higher. Small-cap index actually down 6-7% for the year. So that's been the story as we count down to the end of what has been a bit of a forgettable year for the bulls over here. 3 more trading sessions. Will they come out on top, at least in these last 3? So cues for today then. Like I said, Wall Street actually saw more of that trade broaden out beyond AI names, but the tech names also did fairly okay. At the end of it all, we didn't have too many cues. So little change on the indices, S&P 500, the Dow, the Nasdaq, all of them ending little change. The S&P, by the way, is now S&P 500 is just around 70 points away from yet another milestone, the 7,000 mark milestone. So watch for that. Dollar and yields, again, range bound. We don't have too many data points in terms of, the macro releases either. So the US 10-year was around this 4.13 sort of a handle. The dollar index just below 98. That's what we have. But the headlines have been coming in from the precious metal space. Now, initially, it seemed like this is just holiday thin trade, lower on volumes, and therefore you're getting these outsized moves or whatever it is. I mean, some of those moves continue in Asian trade this morning as well. So silver surges about 11% on Friday. It surges more in Asian trade this morning, hitting a level of $80 to the ounce. I mean, that's the kind of rise that we're talking about. Gold has also continued to march on. Spot gold hit a record high of $4,533 in US trade on Friday. Gold futures at almost $4,560 is what we are talking about. And it's not just silver and gold. Platinum, palladium, all of these metals have been surging anywhere between 10% to 14% in US action on Friday. So watch for the precious metals space. Now, let's come to geopolitics, because that's been the other big talking point. There was this high-profile meeting in Florida yesterday between President Trump and President Zelensky. So what are the two sides saying? We don't have anything very definitive from the Russian side just yet. But the right kind of noises came through. Actually, let's hear out the US president summing up his meeting with the Ukrainian president, Zelensky.
We had a terrific meeting. We discussed a lot of things. As you know, I had an excellent phone call with President Putin that lasted for over 2 hours. We discussed a lot of points, and I do think we're getting a lot closer, maybe very close. But if things don't happen, they keep fighting, and they keep dying. And we don't want that to happen. He doesn't want it to happen. President Putin doesn't want it to happen.
There's a lot of talk, but once again, there's, we don't have anything really concrete. And over the weekend, by the way, Russia has continued to pound Ukrainian territory. So those drone strikes have not stopped for even a second. With all of this, where we're left now for the Nifty, absolutely range-bound. The fight continues around the 2,600 mark. So 26,200 has been the upper end of the range. And about 26,000 to 29,500 has been the downside, the immediate downside. And let's see if the bulls will break out away from that, because we don't have too much of, too many global triggers at least. The FPI selling, by the way, is still relentless. We had more of it in the previous trading session. And so far in December, if you thought Santa will come and it'll take away some of this FPI pain, well, that's not really happened, because we're talking about 14,700 crores of FPI selling in December. 3 more trading sessions to go. But Rima, beyond all of the global headlines, plenty of local news flow. And Coforge, just when you thought the IT year is over, what a big bang announcement from Coforge.
Indeed. It's so Coforge, on expected lines, has went ahead and announced the acquisition of Encora for $2.35 billion. It's a bold, transformational acquisition, but analysts say it's a bit pricey. But the question is, since the stock was down 10% ahead of the announcement over the last week, are the concerns priced in? So that's going to be one big stock to watch. The other one is Timex, where the promoter will be looking to sell nearly 9% stake via an offer for sale. And not to forget the defense stocks, because the DAC, Defense Acquisition Council, will be meeting today, where they will take up proposals to acquire weapon systems worth 80,000 crore rupees. This DAC Council meet was expected to be held on Friday, but it's going to happen today, and the last one of 2025. Just to put the flows of Friday in context, the DIIs bought 1,772 crore in the cash market, while the FIs net sold 317 crore. So what's on tap today? We've got the India IIP data that will come out at 4 p.m. As I said, defense stocks, the DAC will be meeting today, so watch for the stocks there. On the global front, the US home sales data and the information will be out today. This week, I think the big one is going to be the Nifty monthly expiry tomorrow. On the global front, the S&P Case-Shiller Home Price Index, the jobless claims, the FOMC minutes will be out on 31st of December. And generally, through the next 2-3 days, year-end portfolio rebalancing will take place. Then comes 31st of December, where a couple of global markets will be shut early, UK, France and Hong Kong. And then on 1st of January, all the global markets except India will be shut. And thereafter, as we enter January 2026, the December monthly auto sales numbers will be out. So that's going to be the start in terms of the economic calendar for the Indian markets.
Yeah, the point that hurts the most is the one that you made on the 1st of January, right? All global markets except India shut. Well, that's been the story for many, many years now. Okay, so as we talk about more of these local cues, and we'll get to the individual stock action in just a bit, let's also put the spotlight on what is happening with commodities, particularly these precious metals. What's going behind these moves? You thought the year was done already, but then you've got 10 to 14, 15% kind of surge in the entire precious metal space. So let's understand what's happening. Peter Maguire, CEO Trading.com, is with us. Peter, thank you for joining in. Season's greetings to you. Merry Christmas. And I'm so happy that you could take out a little bit of time for us.
Look at the tie, Surbi. It's going perfectly with the Christmas festive spirit.
Absolutely. So Merry Christmas, Peter. Thank you. Thank you so much for joining in during the holidays. But we pulled you out of the holiday to understand what's going on. You thought everybody would go home, be happy with the gains we've already seen on gold and silver. But then you've got this 10% move from Friday and more gains in Asia this morning. So what's happening here?
Well, good morning, Surabhi, and season's greetings to everyone, and hello, Rima. A couple of things. What I think it's hit everyone out of surprise, and the market certainly in this time of year, we do see these unusual sort of moves. It's not unusual to see unusual moves. And what we saw this morning, nearly at $84, $85 an ounce, was just, I think, absolute showtime. So everyone's recalibrating, looking at forecasts moving forward, Surabhi. there's no doubt that silver's now a $92 to $95 handle. That's what everyone's thinking as far as sometime by end of January, if not sooner. Gold will probably edge up in that time as well. I'm thinking around that 47, 45 sort of number. And we've just got to be conscious. If you're looking at the big picture, I was just looking at some notes. London Bullion Exchange has $700 billion worth of gold as far as bullion that can be used for liquidity squeezes. There's nothing, not a single ounce there for silver.
Do you want to just revise the levels for us, Peter McGuire? Peter, where gold and silver heads from here?
Well, I think hello, Rima, by the end of January, I'm thinking around that 92 handle for gold, for silver. I think it's got the capacity to be there, and it might be there even quicker than by the end. That's a month away, and the way it's moving is just, it's parabolic. Gold, I'm thinking around that 47, 45 sort of number, 4,745. US dollar index sitting right on 98, 10-year at 4.13. So I feel as though the US dollar will come under further pressure to the downside, and I think that will, and a number of other key points that possibly come into action over the next month or so. President Zelensky and President Trump and President Putin, what's happening as far as Venezuela, and I think there's a number of geopolitical themes that are going to play out very quickly.
Yeah, Peter, I thought that, a lot of what we're seeing in silver in the last couple of days, I thought that would be, just excessive speculation. But you just said something very interesting. If I heard you right, you said there's no silver, physical silver for squaring off trades at the London Metal Exchange. So is this then real demand?
Well, exactly right. That's the issue, Surabhi. I mean, you've got $700 billion worth of bullion available. Should there be any form of squeeze or event of liquidity problems, that's out of the London Bullion Exchange or London Bullion Market, but there is not any reserves there for silver. And that's the issue. That really, I think, captures a lot of the mindset, and traders are looking at, silver as the standout. It's been extraordinary this year. I don't know what it's sitting at. It might be 165% now up for the year. I'd have to look at the numbers and just, work it through, but it might be 175%. It's extraordinary. So that move is, again, creates parabolic situations, and that's what we're sitting in. It's been really, really like that for the last 2 months.
But are you expecting a shakeout, a significant shakeout, especially for silver, which has just gone in an overdrive?
Well, it's certainly overdrive. I mean, it's like a V12 Lamborghini on an autobahn at the moment. It's running at 300, and it's probably got more upside yet. So I'm not going to call it short anytime soon, because there it is on the screen, 168%. I mean, that's extreme. If you would have told me that this time last year, I would have laughed, and I would have said, Surabhi, I don't think it can get there. But now it has, and we've got a couple of days left of trade. So we might even punch out a 180%. And I think it's too early to talk about being short. The momentum to the upside is very strong, and let's just see where it rolls. But it's very, very dynamic trading at the moment.
So, Peter, one of the drivers of silver fundamentally is the AI trade and its use in AI data centers, PCBs, etc. If the AI momentum slows down in 2026 on account of their own concerns, valuation, the infrastructure spending, etc., what happens to silver in that case? Do you think go ahead.
No. Well, I take all that on board, Rima, and I didn't mean to cut you short. But the issue is, yes, there is a critical shortage as far as investment, and that has been demonstrated over the last 2 to 3 decades. So it's not as though that you just go out and find more silver tomorrow. The issue is that we haven't spent the money over the last couple of decades as far as CapEx on mining to meet demand. And now there's this critical shortage. If there was to be a tailwind, or if there was to be some sort of, softness entering the data center market and, AI, then I think we'll have to deal with that then. But remembering that it's a wonderful conductor for electricity, we understand from a technology focus, photovoltaic cells, electric vehicles, you name it, silver is used in it. And I think that 26 is going to be a very strong year for it. So I can't give you a forecast where it is this time next year, but hey, the way it's going, pick a number.
So you said, one of the drivers is the critical shortage of physical silver due to inadequate mining over the last couple of years. Could you put some numbers to this? I mean, demand versus the supply for silver?
I mean, I've got all the notes, but I can't pick them up, instantly. Pardon me. But there is the likes of the market is that there has been huge demand across the whole complex, from data centers to electric vehicles to electricity demand to all forms of the usages of silver, and we haven't met that demand side. There has been a shortage, and President Trump has had that 60 metals that he's issued as far as rare earths and critical minerals. Silver is right in that pick. So it's just it could end up being just a typical short squeeze. The paper market could get really, and this is where it's interesting. You've got physical demand versus the paper market. And if you're on long side of the paper market, you may want to take delivery, and that forces the people that are short to come up with the silver. So there are very many dynamics that can play out in the complicated world of derivatives.
Peter, as we let you go to enjoy your new year, quick word on crude as well. From an India standpoint, that's been the only silver lining. We've had one less hassle to deal with. Crude has been so ranged, right? And it's down about, I think, 15-16% for the year. So say, first quarter of 26, what happens? And also give us both the scenarios. If Russia and Ukraine keep fighting, then what are we talking about on Brent? And if indeed there's a breakthrough and the war ends, and this peace plan works, then what should we expect on Brent?
I think first off, if let's assume that there is a deal done, Surabhi, and there is a package put together, then you're going to strip out a few bucks as far as any form of war premium. So there's the first part of it. So you've got Brent sitting at 58, at NYMEX crude probably at 55 or 54. And there'll be a downdraft. We're also conscious as far as from the 1st of January, President Trump increasing through his big, beautiful bill, more drilling. And the forecasts are there, 15.5 to 16 million barrels a day over the next year or two. So that's going to increase dramatically. There's going to be excess crude. It's going to be great for consumers because it's going to be lower costs, and that's going to be a flow-on, beneficial certainly to India and very much to the world. So I think inflation will be softer, and that's a benefit all over for everyone.
Peter, thank you very much for joining in. Take all those points on board. Wish you a very happy new year and look forward to an early conversation in 2026. Well, that's what's happening, and that's the expectation for gold and silver, which has shattered all records in 2025. Silver up 170%, gold up 70%, on track for its best annual gain since 1979, and gold prices in 3 years have gone up from $1,600 an ounce to $4,500 an ounce, so that it's been a multi-year bull run for gold prices too. Let's also tell you what we've lined up for you on our show today. So coming up at 8:35, we've got the management of BLS International to discuss their outlook for the second half of the year. 9 a.m., Wedbush Securities, Moshe Khatri will join in to talk about Coforge's Encora acquisition. 9:20, Invesco Mutual Funds, Tahir Badshah will be a market master for the day. 9:35, the management of Gulf Oil Lubricants will join in to discuss the outlook for 2026. And following that, the management of Vikrant Engineering will be with us at 9:45 to talk about the recent order wins. Towards the end of the show, we put the focus and spotlight back on the IT stocks and the mega acquisition by Coforge. Bhavin Shah and Sandeep Suvilo will join in.
Okay, so that's the lineup. And as we get into the break, let's give you a sneak peek of all the top stocks that we will be putting the spotlight on. Coforge, of course, tops that list, as Aurobindo Pharma, Vedanta, Hindustan Zinc, John Cockerell, all of these on the back of positive news flow, so they could have a positive start. Countant, Titan, and Segal India as well. And there's Timex, where there's a large block trade in focus. Tata Steel and Segachi Industries on the downside, perhaps. We'll tell you more as soon as we come back from the break.
Welcome back. It's a Monday morning and it's the final trading week of 2025. This is the week where we bid adieu to 2025 and we welcome 2026. But we're not bereft of any news There are lots of stocks you need to have on your radar, and this is CNBC TV18's list of top stocks for the day. But let me begin this one because Coforge has announced a very large acquisition. Good morning, guys, but let me take this up first. So Coforge has announced a very large acquisition of Encora for $2.35 billion. But the stock, in anticipation of the deal, had already fallen about 10%. Now, the company that Coforge is acquiring is estimated to have revenues of $600 million in this year, with adjusted EBITDA margins at 19%. So when combined with Coforge's top line will increase to $2.5 billion, EBIT margins will be 14%, and the management categorically saying this acquisition will be EPS accretive from day one, FY27 itself. Now, with respect to the funding, because that's where the concern came in, it's a large acquisition, how will they fund it? Well, this is an all-stock deal. Out of the $2.35 billion, nearly $1.9 billion will be done via a share swap, which means the existing shareholders of Encora will be given shares of Coforge at a price of $1,815, which is about an 8% premium to where the stock closed yesterday. And Encora shareholders will have about a 21% holding in Coforge. But there is a balance which will be required. Now that the company says they could look at a bridge loan or a QIP. I mean, QIP is one of the many options that they are considering, but predominantly this will be funded via the share swap, an all-stock deal of $1.9 billion. Now, the company in the conference call, Sudhir Singh, says that this is a defining moment for Coforge and will accelerate growth in a higher orbit. Now, what are the concerns? One, the PEs will have a 21% holding in the company because Encora is owned by Advent Warburg, and generally PEs don't stay forever. So that's, stake sale overhang will remain, and two, the dilution of 21%. Now, Kotak says, just to summarize the brokerage verdict on this, the asset is good but pricey. If the company has to achieve EPS accretion, as the management is promising, it will require sharp and immediate execution of synergies. Morgan Stanley is also bullish, overweight rating. They say it's a selective niche, bold move, which expands the company's addressable market, though in the near term, it will be dilutive. Now, the only question is, it's a good asset, short point, good asset, it's expensive, but considering the stock has already fallen 10%, how much of it is in the price now? We'll have to wait by to see the near term and the medium term. The medium term really depends on the way they execute this large acquisition.
Yeah, so it's a risk. But then, Indian IT companies have always been faulted for not taking enough risk. Coforge anyway has been the one with more acquisitions, the higher growth rate, and now they've gone ahead with this big deal. So we'll see what the market verdict is like. So Coforge definitely on our radar. Ekta's also joining in. She's watching out for some pharma names. Ekta, morning. So Oro Pharma on your list?
Well, yes, Aurobindo Pharma is there on my list because Curatech, which is basically their arm, has terminated an agreement that they had signed in 2023 with Biofactura, a US-based company, which is basically for a proposed biosimilar product to Stelara, Stelara is the biologic which exists. So this was basically a deal on the biosimilar of that particular drug. The company says its decision is aligned with Curatech's strategic portfolio prioritization. It's not expected to have any material impact on the company's overall biosimilar strategy. And remember that Biofactura under this deal was receiving license fees, milestone payments from Aurobindo. So maybe there could be a little bit of a relief rally for Aurobindo, considering that those payments then would then not be something that they would have to undertake in the future.
Okay, all right, got that. Ekta, thanks very much. So Aurobindo Pharma is going to be on our radar. Let's hop across to Vivek. He's watching out for Timex, where we're expecting a large transaction. Vivek, tell us more. Morning.
Well, that's right. Good morning. So Timex Group India, the Indian listed entity, is in focus. After June 2025, where the promoter group, which is Timex, the MNC that held majority stake, had divested 15%. Now they're again looking to divest close to 9%, 8.93% to be precise. So this particular 9%, is going to be done via an offer for sale route, a base size offer of close to 4.5%, and a green shoe option of close to 4.5%. Now, the floor price for this particular transaction is at 275 rupees a share, which is an over 21% discount to the last traded price of Timex. The total size of this particular OFS is 250 crore, and the stake of the parent will now fall to 51% post the OFS. Again, you're seeing quite a lot of exits as far as MNCs are concerned in the Indian listed entities.
Thank you very much for that. But back to talking about the record rally in gold and silver and what happened over the last 48 hours. Manisha now joins in. Manisha, what a bazooka move on Friday.
Oh, well, bazooka, absolutely. You know, silver clearly has been an open secret trade throughout this year. Everybody knew that silver was going higher because you're looking at all positive cues lining up for that. But people did not know where it would really see the end of this rally, and that's exactly where we're standing right now as well. So from starting with $29 to trading up to $81 an ounce, markets do believe that $100 an ounce is not too far away, and whether or not silver will give correction before that is a big question mark. You have absolutely no sellers in this market. On every dip, there is more buying that you continue to see in case of silver. What has happened in the last 48 hours has been even more investment buying that we've seen, especially coming in from U.S. You know, as we get into January, the U.S. Commerce Department investigation on whether or not import of critical mineral pose national security risk, well, that report will yield result by mid of Jan. If it's a yay, then you will see silver prices just run up much higher then. If it is not on the critical mineral list, well, that is when you will see some profit taking coming in. So it really is either ways, and nobody wants to be short ahead of that result that would come in from U.S. Very strong gains is what we continue to see even today. We started Asian markets with $75 an ounce. We're already back at 77 and 78. So as I said, every dip is getting bought into this market. The decline in dollar index, the deficit, speculative buying, industrial uses. 60% of silver right now is used in industrial matters. That is the cue that's coming for 2025 and is what you could see in 26 as well. So, well, yes, this one could continue to really, really test your patience on the higher side even now.
Oh, absolutely. We got that new view from Peter Maguire just a while back. Manisha, he said, I'm not shorting silver. No chance. There's too much momentum on the upside. So absolutely getting those views from the market. Thank you very much for making sense of it for us. So that's silver in focus. And we'll keep watching out for some of the stocks like Hindustan Zinc on the back of this huge surge in silver prices. Let's now get to Upasna. She's got a couple of stocks on her radar as well. Morning, Upasna.
Good morning. First up, let me start with John Cockrell India on the back of the bulk and block deal. Now, Ramesh Damani has bought nearly 27.5 thousand shares in the company at 4,704 per share, while the promoter, that is John Cockrell SA, has sold nearly 1.9 lakh shares in the company. Next up is Titan. The company enters lab-grown diamond jewelry market with the brand name BU. And the company says that it aims to tap into the India's growing demand for affordable diamond alternative. It will be opening its first exclusive store in Mumbai, is what the company has indicated. Next up is Tata Steel. The company gets GST demand and penalty order worth 1,781 crores for FY 18 to 21. Sigachi Industries is also in focus as the MD and CEO of the company, that is Amit Raj Sinha, has been remanded on 27th of December in connection to the ongoing investigation relating to the fire incident in company's Hyderabad plant. Hence, this stock will be in focus. And lastly, coming to Seagull India, the company has received LOA worth 1,089 crore from Madhya Pradesh Road Development Corporation Limited for construction of Indore-Ujjain highway project. So all in all, we'll be watching out for all these stocks in today's trading session.
Okay, all right, got that. Thank you for the details there, Upasana. So lots of stocks on our radar. Let's quickly recap our list then. The ones that have positive news flow around them today are Coforge, Aurobindo Pharma, Vedanta, Hindustan Zinc, John Cockrell India, Sigal India and Titan. Stocks with negative news flow would be Timex, Tata Steel and Sigachi Industries. We'll take a quick break on that note. Up next, Amnish Agarwal of PL Capital will join in with some fundamental stock ideas. Welcome back. As promised, let's discuss a couple of fundamental stock ideas. Amnish Agarwal of PL Capital is with us now. Amnish, thank you for joining in. Good morning. Season's greetings to you. So lots of stocks to discuss actually today. Let's start with Coforge. What a large transaction, right? Over $2 billion. And a lot of it is being funded via the share swap. Then they'll probably do another QIP. What do you think of the deal?
The deal actually, good morning. The deal actually positions them well on the AI space because AI is something which is like a new buzzword. Everyone is trying to grow into that segment. So these two billion plus kind of an investment that actually will position them well into that segment. But as of now, the company which they have acquired is growing at just around say 10% or so. So in the near term, I don't see a very big accretion happening to numbers for the company, but in the longer term, it will depend upon how they are able to capitalize on this acquisition and how it actually adds to their growth and profitability. But in the near term, I don't see it is going to be EPS accretive for them.
So, I mean, what would you recommend if someone is already holding Coforge shares and they're already off the peak, quite a bit off the peak? Is this the time to get out till this acquisition settles? What would be the advice from a stock perspective?
I think you see,
I think we're having a bit of a trouble with Amnish's audio. Just fix that. So Coforge is about 16% off its 52-week high. Stock has corrected, and it's down about 13% this year. That's, of course, what happened on Friday. Pull up a longer-term chart. What was once the poster boy of the IT pack, given its fast growth rates. It was the fastest-growing IT company, mid-cap IT company, for quite a while. Managed steady margins. But then, a couple of volatile points. They spoke about data centers. That led to a huge amount of volatility. Then the stock recovered from there. And now we have another big news in terms of this acquisition. Let's see if we can go back to Amnish. Amnish, yeah. Okay. No, I don't think we have that line ready with Amnish. We'll get to him in just a bit. So let's do one thing. Let's take that time to connect with the management of BLS International Services. That's the company on our radar. The stock is down about 30% in 2025. So it's been a tough year for shareholders. But the company has seen 46% growth in the first half of the current fiscal year. To talk about the outlook from here on, we have Shikhar Agarwal, Joint MD at BLS International and Chairman at BLS eServices. Three key talking points. Shikhar, thank you for joining in. Season's greetings to you. So three key talking points that we want to cover. Whether 40% plus kind of growth can continue for the rest of the year as well. What about their focus on digital services? What are they thinking on that front? And can the company return to 30% margins as this year closes out, as we enter the new fiscal? So let's take all of these questions one by one, Shikhar. Let's talk about the growth rate. While the stock has languished, like we just pointed out, you've had a good first half. What are the trends indicating? Will you end, say, with 35-40% top-line growth this year?
See, if you see the trends, last 5 years, we've been growing at around 50% CAGR. And if you talk about specifically quarter two itself, our revenue obviously grew by around 48.8% to 736 crores. And our EBITDA has surged by 30% to 212 crores. So definitely, we have seen a good growth compared to last year. As we have said, quarter three normally, in terms of travel demand, in terms of visa, is a little less seasonally for us that we have seen historically. So I don't know how this quarter turns out. But going forward, what trajectory that we have given is that next 5 years, organically, our target is to grow at least 20 to 25% year on year. On top of that, there are a lot of new contracts that we are bidding for, a lot of acquisition M&A opportunities as well. If you see last year itself, we've acquired companies worth around 12 to 1400 crores, and similar amount of cash is again at the end of quarter two in the books of the company. So we definitely feel there's a big opportunity for growth going forward.
Okay, so you've given us a couple of touch points here. A, you're saying that what was a 40-50% CAGR run rate, that might come down to about 25% in FY26 going into 27, right?
See, what I'm trying to tell you is that with the small base, obviously, company grew faster.
Oh, sure. Yeah.
Now with the increased base, our immediate target is organically, with the existing business that we have in hand, with the existing volumes, existing per application growth, we expect at least 20 to 25% growth. But on top of that, there are a lot of new tenders that we are bidding for and a lot of new M&A opportunities. If those get added, then definitely growth can be much further.
Okay, so we'll talk about the acquisition and the M&A opportunities in just a bit. But just to complete the picture on the base business, the organic business, which you say will grow at 20-25%. In the visa business particularly, I just want to understand what is your exposure, what is the contribution from, say, the US? Because that's where a lot of headlines are about what's happening, too much confusion, delays in visa applications. So will that weigh? And if yes, to what extent on your visa business?
See, we started working for the US government recently after the new administration came in. So we have not seen any big numbers as such already. So anyhow, if the numbers increase, it will only add to our revenue and margin. So we recently started working for the US government in a couple of countries, and we have seen some numbers coming in, but the volume has not reached its peak. So we can definitely feel that there is a big potential in terms of US visas as well.
Shikhar, just to get back to a thorny point that took place a couple of weeks back, initially the Ministry of External Affairs barred BLS International from participating in future tenders. Thereafter, the Delhi High Court quashed this, which means you are eligible as a company to participate in tenders. But is this the end of this issue, or do you think the Delhi High Court order may be challenged and once again the company could be barred by the MEA?
See, what I know is what we've already announced to the exchange, that we have got this approval where we...
Oops. All right, that is, we'll try and reconnect with BLS International, but just to summarize what he had to say, typically the December quarter is slower for the visa business. It's great for travel business, but for the visa business, it's typically seasonally slower. So we'll have to see how Q3 pans out. But overall, over the next 5 years, he's confident about organic growth sustaining between 20 to 25%. And on top of that, the company will be continuing to scout for acquisitions. They have been acquisitive. Last year, BLS, Shikhar was telling us the company spent about 1,200 to 1,400 crore in terms of acquisition. So that will boost the overall business. Also, the margins for the company have been steadily expanding over the last couple of quarters as the company is making more revenue on per visa application. So the net revenue per application has been steadily expanding for the company. So for instance, in Q2 of FY24, that's about 2 years back, they used to make about close to about 2,000 rupees on every visa application. And that number went up to 3,200 per application as of the last quarter. So that's been helping the company's overall visa margins as well. Shikhar, you were telling us about this issue from MEA and whether there is a possibility the company could be barred in the future.
See, as we have already announced to the exchanges, whatever relief we have got, we have announced that to the exchanges, and now we are eligible to participate. And as and when the tenders come, we will be participating.
Okay. And what is the contribution of that business as of now with this whole ban?
Around 12%. Around 12% of our revenue comes from the business that we do for the MEA.
And you expect that to keep growing, despite this legal issue that kind of cropped up?
No, as we have already announced that we have got the relief and we continue to participate in the future tenders, whatever revenue we currently have will remain intact.
Got that. I think from October, November, about 1-2 months back, there were direct flights which resumed between India and China. And remember a couple of years back, you're saying that our growth has not gotten back to the pre-COVID levels because Russia and China, as a market for tourists, had shut down, had closed. Now that at least China has opened up, can you give us an indication of the number of tourists or the number of visas that you have filed for? And how much of an incremental growth driver can that be for your company?
See, definitely China is a big outbound travel market. And in 2019, there were around 400,000 Chinese visitors that came to India as tourists. And as you know, we recently won a contract for the Indian Embassy in China, where we have deployed offices for the Chinese who want to travel to India. So we feel that since direct flights have now started, there could be a big surge in numbers. And if the numbers come back to what was happening pre-COVID, there will be a big boost in number of Chinese who are coming to India. And also, it will be beneficial for the Indian tourism sector.
Okay, so 400,000 was the inbound travel from China into India in 2019. Do we have the number for 2025, especially in November, December, since, direct flights have resumed?
No, I don't have the exact numbers right now, but we definitely know this is where the peak was achieved at.
Mm-hmm. So, Shikhar, getting back to a point that you sounded fairly excited about, and that was M&A growth, basically, growth beyond just the organic business. And tell us what you're thinking there, because also that ties in with the fact that I think over the years, you're trying to pivot away from being purely focused on the visa business, right? This digital services business. I think first half, your visa business generated revenue of about 900 crores. Digital services generated revenue of just over 500 crores. So it's growing. What are your plans to take it up a notch? And what kind of M&A do you have your eye on? Will we see another deal before this financial year ends?
No, first of all, the visa outsourcing market is growing around 14% CAGR annually. If you talk about the existing business plus new governments outsourcing for the first time, the visa market continues to grow. And even if you see today, around 60 to 70% of our revenue comes from visa outsourcing business. So our immediate focus definitely is also on growing that. But if you see our digital business, we did some M&A last year. We acquired this company, Artifilis. We won some new contracts. So definitely we have seen a good growth coming in the digital business itself. But in the next few years, I feel the growth trajectory from both the businesses will remain steady fast. And that is the reason we listed our subsidiary BLS e-Services separately, which contains the digital service business.
One more acquisitions in which business? The legacy visa business or the digital business? And when do we see those acquisitions?
See, we recently announced last year 3 acquisitions, which was the biggest acquisition in the history of the company. But we have a big M&A team. We continue to look at opportunities both in the visa business as well as the digital service business. As you may see, we recently also won a big contract, a 2,000 crore contract from Aadhaar authorities to process Aadhaar applications within India. So those revenues will also start coming in probably from the next 2-3 months.
Thank you, Shikhar, for joining in, and wish you, your family, the entire team at BLS International and e-Services a very happy new year. Thank you very much for joining in. All right. Getting back to our conversation with Amnish Agarwal. Amnish, the other big stock, on Friday was Titan, as the company announces its official foray into lab-grown diamonds, with Beyond. Can you give us your initial thoughts, and can it add to the target price or the EPS numbers for Titan?
See, the foray of Titan into lab-grown diamonds, I think it is a big positive for the company, because gradually the market for lab-grown diamonds is picking up in India. And given the kind of brand equity Titan is having, they will definitely gain from this. And I believe the only thing is that it's a new brand, so the new stores will be opened by the company. But given the track record of the company in cultivating brands and growing them, I think it actually removes the uncertainty which the street had, that if the lab-grown diamonds pick up significantly, how will Titan gain from it, or its core business might lose out from this. So I think from that angle, the Titan continues to look good. As far as you're adding you can say it to the SOTP is concerned, I think as of now they are going to open just one store, and I think they will scale up over a period of time. So as the time goes, I think it will get added into the target price both as well as on the SOTP. But nonetheless, in the near to medium term, the outlook on this stock remains quite positive.
Okay, so that is Titan in focus on their lab-grown foray. Interesting. Couple of months back, we asked the company when the lab-grown competition was really heating up, whether they want to get into the segment or not. That time they didn't exactly reveal their cards, but now we know what those plans are like. Amnish, just want to talk metals, because look at what's going on with the precious metal space, silver in particular. And the one direct play that we have is Hindustan Zinc, and that stock's also been sort of shooting up like a rocket. Would you look at any fresh purchases in the metals pack?
You see, as far as the metals are concerned, I think all these stocks like they are because they sell metal.
Okay, I think we have a bad line with Amnish today, unfortunately. So we'll let it be for today. Amnish, sorry for that. Hindustan Zinc, yeah, keep that stock on your radar. In just the last 1 month alone, 30% higher, tailgating basically the surge that we've seen in silver prices. What a move the stock has seen. Well, with that, let's take a very quick break. Lots more coming up on the other side. We'll have our technical experts joining in with a couple of trading ideas for today. And then, of course, Hormuz will focus on some interesting stocks tracking delivery data from Friday.
Welcome back. Now let's put the spotlight on stocks that brokerages have highlighted this morning. Sudarshan now joins in. Sudarshan, what's on your list?
So I have two stocks, Titan and Stylem Industries. Titan basically company has fallen into lab-grown diamond business, and on the back of that, two brokerages have returned with different or contrast take. First one is Morgan Stanley. It has a positive take on that, and it maintains overweight call, and target is 4,062 per share. It says companies fall into lab-grown diamond jewelry with Beyond brand, and this about 12 to 18 months ago, company was basically Titan was averse to that, but now, with company falling into that, Morgan Stanley views this as a positive and a step in the right direction. But as far as Citi is concerned, it maintains neutral call with a target of 4,125 per share. It says announcement of foreign to lab-grown diamond business comes as a negative surprise, and it does not expect Beyond to drive any meaningful growth or earnings for the company. And this foray may pose risk as it signals its admission of being a threat to natural diamond business. There was a deal in Stylem Industries last week, and after the Investec has written a note, it maintains buy call and target is 2,300 per share. It says promoter group's 40% stake sale resolves a long-standing governance gridlock, and AICA Kogyo brings deep expertise, strong brand equity, and operational synergies, and robust fundamentals already is in the place for the company. And with improved governance and strategic clarity, that sets stage for a further re-rating that company might see over the next few months.
Okay, all right, got that. So Darshan, thank you very much. So we'll keep these stocks on the radar. Let's now go across to Hormuz, who's tracking some of the interesting movers and shakers from Friday's trading action, looking at the delivery stats. Morning, Hormuz. What did you pick up?
Morning, Surabhi. And it was the day that belonged to railway stocks last Friday. They continued to chug along for the fifth straight day and for the week as well. If you take a look at their weekly returns, you pick up any railway stock, it had double-digit returns. Jupiter Wagons, IRFC, RVNL, all of them up anywhere between 15 to 30% last week. So it was a week after a while that railway stocks were in the reckoning. And if you take a look at the volumes as well on Friday, for RVNL, over 10 crore shares traded, for RFC over 16.5 crore shares traded, for IRCON 5 crore shares traded, and all of them significantly above their 20-day averages as well, which ranged from anywhere between 50 lakh to 1 crore shares, so anywhere between 10 to 15x of their 20-day average. But the delivery volumes though, now for RVNL, out of the 10 crore shares traded, only 1.5 crore were marked for delivery. For IRFC, 3.5 crore shares were marked for delivery, while for IRCON, only 65 lakh shares were marked for delivery. So the delivery volumes left a little more to be desired for the railway companies, but they continued to move higher. They remain in the reckoning today as well. Now, Karur Vysya Bank was one such name that made a move on the upside on Friday. It snapped a two-day losing streak, ended at a 52-week high. The volumes on Friday were the highest since June of this year. Over 1.5 crore shares were traded, the 20-day average of around 14 lakh shares, and out of those 1.5 crore shares that were traded, 34 lakh shares were marked for delivery, the 20-day average being around 7.5 lakh shares. So the stock has done well, is up 40% so far this year, turning out to be the fourth straight year of positive returns for Karur Vysya Bank. And lastly, MMTC, the stock was up for the sixth straight day on Friday. It was the biggest single day gain since May, as well as the volumes as well. Now 7 crore shares were traded on Friday for MMTC, the 20-day average of around 27 lakh shares. And out of those 7 crore shares though, only 50 lakh shares were marked for delivery. Yeah, the 20-day average here is just around 5.5 lakh shares. Mind you, MMTC is a low free float stock because the government has close to 90% stake in the company. The stock down around 26% from its 52-week high, which is close to around 90 rupees a share.
Got that. Thank you very much for that. On that note, we will slip into a very short break. We'll come back with the pre-opening rates. We'll also be joined by Wedbush Securities' Moshe Khatri to talk about Coforge's Encora acquisition, and we'll also connect with Sudarshan Sukhani and Mitesh Thakkar for some technical trades.
Welcome back. Well, just 5 minutes to go before we start getting our pre-open rates. And the cues have been fairly range-bound. I mean, we don't have too much of a directional call coming in from Wall Street, and some of the Asian markets have managed to track some gains. So let's see what the trading bet or the trading stance should be like today. We have our technical experts joining in, Sudarshan Sukhani as well as Mitesh Thakkar, and 26 points higher on the implied open. as we go to the gentlemen. Morning, both of you, and season's greetings, all set to wind down the year, Sudarshan and Mitesh. So the question is that, queues are thin, maybe volumes start thinning out as well. So on the index, should one be taking a trade? And if yes, then in what direction? Mitesh, let me open with you.
Yeah. Good morning. So I think, the index part is slightly tricky in the sense that, we are still, not showing signs of any directional breakout or breakdown. We've defined boundaries now. 26,200 is a pivot, but the breakout happens about 26,300, and on the downside is about 25,800 to about 25,750. So if you look at the indicators, most of them are flat. The volatility indicators are also sideways. So I don't think, as of now, we should be just deploying range bound strategies, which means that you want to try and buy near the lower end of the range and take profits or even attempt shorts around the upper end of the range.
Range continues. Sudarshan, what would your call be?
Yeah, good morning. Well, the call is that we are in a trading range. I think we can all see that. But within that trading range, we are at the upper end of the trading range. Now, there is an imminent breakout in the Nifty, which should happen. Whether it happens this week or next month, I can't say. But we should be positioned for that. So the trade for me is to be on the long side of the market, buy the Nifty on a dip towards 26,000 and keep a tight stop loss. That's the trade for today at 25,950. So with a very small risk, take a dip and go long if you get that small decline.
What about stocks, Sudarshan?
Well, I have Dabur as an intraday short, stop above 496. The other three are all buying ideas. K Fintech, which has been doing well, buy with a stop under 1070. Marico is a buy with a stop under 731. And BHEL has an excellent chart, so it's a positional buy, intraday buy with a stop above 275, stop below 275.
3 buys, 1 sell. Mitesh, what are you going with?
Similar template. I think I have 3 buys and 1 sell as well. On the buying side is K Fintech. I think Sudarshan also mentioned that a good chart showing reversal signs. So keep a stop at 1079. Look for targets of 1140. Buy on Ambuja Cements with a stop at 544 for targets of roughly around 575 on the upside. Marico is a buy as well. Keep a stop at 733. Look for targets of 765 and 1 sell call. And it's a conditional sell. So Adani Ports is now showing signs of profit booking. If it breaks 1480, 1479, I think you might see some more correction. So sell below 1479. Then keep a stop at 1496. Look for targets of around 1440.
Mitesh, any call on Coforge after the 10% decline recently? Has the stock bottomed out for the near term? Is there a trade?
See, bottomed out, no. I think very clearly this is a market, which has fallen freely. There's no accumulation or stoppage at the lower end. Oversold, yes. I think, if you look at the 2-hourly, 4-hourly charts, there are indicators now in the oversold region. So I think you might get a bounce back for a day or two. But on the upside, 1750, 1780 zones is where I think, this bounce back could end. So I would, want to use any kind of short-term upsides to exit in case I'm holding this stock.
Thank you very much for that. We'll come back to you, gentlemen, for the 9:10 call. For now, let's get back to talking about Coforge. And Coforge announcing the big acquisition of Encora, US-based Encora, for $2.35 billion. At CNBC-TV18 had reported with this, the combined entity will have revenues of $2.5 billion and a big play in the AI field. AI itself will contribute about $2 billion to the overall top line. Listen in to what the management had to say about the acquisition, why they're doing it, the rationale, the synergies in the conference call.
So the acquisition of Encora is a defining moment for our organization. And I mean a defining moment. Born in the Silicon Valley, California, Encora is one of the select technology services firms with an AI native DNA that provides software engineering services for digital native companies and Fortune 1000 enterprises. Encora works at the convergence of AI, cloud, data, with service offerings that span intelligent process design, agent native product engineering, core modernization, AI foundation, data readiness, and AI ops.
From financials perspective, the consolidated turnover of Encora Group for financial year 26, the estimated number, and they follow April to March financial year. So estimated number for financial year 26, revenues are around $600 million. and adjusted EBITDA of the firm is 19%. With Encora's current margin profile and the anticipated synergies that we see in the business, and the combined business is expected to operate an EBIT margin of 14% post amortization of intangibles that will be created as part of the purchase price allocation for this acquisition. Despite the primary infusion, the deal is not expected to be EPS dilutive on a consolidated basis because of the strong margin profile of Encora and expected synergies from the two businesses, that is Coforge and Encora, coming together.
This will reposition Coforge as a player with scaled up nearshore delivery capability in LATAM, with an exceptional engineering and AI talent base servicing US clients. Encora has a large and widespread nearshore delivery capability with more than 3,100 delivery team strength in its LATAM delivery centers. It will significantly expand the West and the Midwest US client footprint of Coforge. Pre-acquisition, as you know, only 25% of Coforge's North America geo unit revenue came from the US West and Midwest. This acquisition will provide a fillip to Coforge's North America growth plans. Coforge's North America business is expected to jump by around 50% to $1.4 billion post-acquisition. The combined firm will now have 45 $10 million plus highly scalable relationships.
Well, that's the word coming in from the management. To discuss this, we're now joined by Moshe Katri, Managing Director, Investment Banking at Wedbush Securities. Moshe, the big question is, the asset is great. It positions Coforge in the big AI league, revenues of $2.5 billion. The management confident that it will not be EPS dilutive. But is the acquisition expensive to your mind? How have you analyzed it?
So good to be here. I would say a couple of things. You will see premium multiples for companies that are operating in high growth areas, whether it's product development, R&D, Gen AI-enabled, tech-enabled services. And this one is actually definitely getting that premium multiple, 20 plus times EV to EBITDA. You're paying here for growth north of 20%. You're paying here for high teens EBITDA margins. And obviously, they're telling you that it's not going to be diluted for their own business. See, the real test is going to be down the road in terms of where the model goes. From our perspective, if you really want to compete in the new Gen AI world, if you will, you have to do two things. You will have to focus more on performance-based contracts. That's how you get paid. And then the other thing you want to do is you want to show this decoupling between headcount and revenue growth. That's going to be the real test for a lot of companies that want to survive this new era. And at this point, only time will tell if this is going to be the right acquisition for Coforge. Encora is a good company. They have good metrics. As I said, the growth looks good. The margins look pretty good. But ultimately, the model is going to have to adjust for this new era. And that's going to take some time to get there.
Moshe, hi, morning. So exactly on that, let's understand Encora a bit more, because Coforge told us that it's an AI native company, and you said that it comes with the promise of 20% year-on-year growth. So what is the opportunity to scale up for Encora, their client base, the way they've adopted their AI models? Can you tell us more about Encora?
Well, the AI model, as I said, is going to have to really kind of reinvent the traditional model in tech-enabled services. And, the way I see it, I'm just not sure that this is where Encora is. The true Gen AI model is going to be reflected in companies such as Fractal, Trident. These are companies that focus specifically on Gen AI. I think Encora has AI expertise or Gen AI expertise, but that's probably among other things that they do. So
it's not ground up AI.
Not exactly a pure Gen AI business, the way I see it.
So you're not convinced that this...
It's not exactly a...
So you're not convinced that this perhaps is the best acquisition for Coforge?
Look, I think for the true Gen AI companies, you probably have to pay a much higher multiple than what they paid for this one. So I think they, for what they were willing to pay, they probably got a pretty decent deal.
So Moshe, just to kind of digress a little bit, there are large Indian IT services companies that have been kind of called out for being not aggressive enough, and they're not making acquisitions. And the point that comes up is exactly what you said, that true, ground-up AI companies are simply too expensive to buy. And therefore, I think a lot of these companies, TCS, Infosys included, they're trying to embed AI in all of their service offerings. So that's one approach that the big boys are taking, the Indian IT services companies. And then there is the second approach, which a mid-sized company like Coforge is taking, of buying tier 2, tier 3, AI derivative companies, which, according to you, will be proven perhaps a better approach.
So I think the tier 1 offshore companies that are repositioning themselves for this.
Okay, I think we've just lost our line with Moshe. Not too lucky with the lines today. Apologies for that to our viewers. We'll try and see if we can get him back. And Rima, that's what I've been thinking, because as someone who's not that close to the IT universe as Rima and the entire analyst community, I mean, you sit outside and you really wonder if, yes, AI is the holy grail, but what kind of AI company are you really trying to be? What is the route you're taking? And Moshe sounded a bit doubtful about whether this entity is really native AI, ground-up AI,
I guess what Moshe was trying to say is that maybe there are 3 levels. One, you're willing to pay top-notch, very high valuation.
To buy OpenAI, which you can't.
For a Gen AI native company. Yeah. Second one is that companies which give you scale are present in AI, but then you're getting them a little cheaper than the tier 1. Yeah. And tier 3 is inaction. And I guess, Coforge...
That's not an option, I guess.
That's not an option, right?
Option 3 is not an option.
That's not an option, because sometimes action is better than inaction, right? A bold calculated. Now it's up to Coforge to execute on it. It will require flawless execution, but I guess that's the point, Moshe.
We have to see. Yeah, we've got Moshe back. Moshe, so that was the question. Which approach do you think sounds most optimal right now? The one that the large IT services companies in India are taking? Or the approach, say, that a Coforge has taken, that you can't go buy top dollar AI companies, so we'll buy the next best thing and try to build scale?
So I do like what the traditional companies are doing right now, just because they have a lot of expertise in the integration side of the business and on the data management and data side of the business. This is really the infrastructure piece of Gen AI, and this could scale and become very large for these companies. Look, I think there's going to be a lot of need for what they have, and especially when some of those Gen AI projects start scaling. If you step back 10 years ago, there was a lot of debate around the cloud, and there was a lot of concern that cloud essentially is going to cannibalize consulting revenues and a lot of work that around, integrate a lot of work around software development or custom software development. And in fact, cloud ultimately created a very large integration cycle for the space. And the way we see it, Gen AI is going to do the same thing for the space. And I think the tier 1 offshore companies are getting ready for that. And in our view, they're in great, the way I see it, they're in great shape to benefit from the cycle once it starts kind of scaling. So there are all kind of different ways to approach Gen AI. Coforge is doing it a different way a bit. But the way I see it, the tier 1s are in great shape to benefit from that cycle once it starts really scaling.
Okay. So which Indian IT stocks would you buy now, if any?
I think the tier 1s are in great shape. Infosys, TCS, Cognizant, the way we see it. If you look at some of the digital IT services companies, Globant, EPAM, they're also in great shape. And then you have some of the others that are kind of focusing predominantly.
Okay. All right, Moshe, we'll leave it on that note. And in case if you can hear our season's greetings, wish you a very, very happy new year. May you have a great 2026, and we'll talk again soon. Thank you for joining us on the call today. That is Coforge Moshe leading a little more towards traditional IT services companies, saying that we need to see.
I don't think he has active coverage on Coforge.
Yeah. So I guess we need to see how the assimilation happens, how the integration happens. And
For now, there are shots in the system. Stock had declined, and you will see some sort of a recovery. But medium term depends on the company executing.
Okay, definitely a stock in focus, and in pre-open, up about 2.5%. Okay, let's talk about Titan and see what Titan is doing in pre-opening, because that's the other stock that's in news today. It's up about 0.5% right now. So let's get you some more details on their lab-grown diamonds foray. Mangalam had a chat with Titan over the weekend, so we got some takeaways. These are exclusive to CNBC-TV18. And like I said, a couple of months back when we asked the company when the lab-grown diamond onslaught had really started, whether they'll move to this segment, they were non-committal. But now, guess what? They say they've studied the market and they are ready for the big splash. So what is Titan really saying? Titan is saying that natural diamond jewelry demand still remains very, very healthy. And they're saying that continues to grow in double digits. That's really important. So Titan is allaying any fears with respect to its basic bread and butter natural diamond and natural jewelry, diamond jewelry business. They're saying that consumers are, now showcasing a need for affordability and fashion wear, daily accessory and fashion wear. And that is where lab-grown fits in. And they want to have a presence in this segment, which is why they're looking at this offering of Beyond. But it's very, very important that Titan is keeping the distinction extremely clear. Beyond is going to be retailed. That's the lab-grown diamonds offering. That's going to be retailed through separate stores. The first one launches in Mumbai, and then they go on to Delhi, and then they'll see how the scale-up needs to happen. But their natural diamond jewelry retail continues, and those plans continue through their existing brands like Titan, like Tanishq, CaratLane, Zoya, and the others. And they're saying that there's continued healthy growth in the natural diamonds space, and that will continue with their expanded retail footprint as well. So that's Titan saying this is an add-on. It's like them offering Tanera in the sari side of it, and therefore it's another lifestyle offering coming in from the lab-grown space. Right now the stock is up about 0.5%. With that, let's quickly get back to our technical experts and get some 9-10 ideas. Actually, maybe Mitesh, throw in a word on Titan as well. Stock's done actually pretty well through the year. It's very close to its peak. So what on Titan, and then of course your call for today?
So one, I think Titan is at all-time highs. Recently, in fact, rather on Friday, there was a fresh swing breakout as it managed to get past 3940, 3950 zones. So I would be very positive, looking at a short-term target of 4200 here. And any pullback to 3950 would be a buying opportunity, and keep stock below 3880.
Sudarshan, your call, 910?
It's K Fintech. Buy K Fintech with a stop under 1070.
That seems to be the consensus buy. We'll watch for K Fintech technically. But for now, let's go across to Hormis now, who tells us more about John Cockerell, a stock that Ramesh Damani bought some stake in.
Yes, that's the big news point for John Cockerell. The stock was up around 6.5% on Friday as well, and it looks to open higher in today's trade as well. We'll tell you more about the company. It's another manufacturer of metal processing equipment, and it also develops technologies for cold rolling, mill complexes, processing lines, and other such facilities as well. Now, Ramesh Damani bought around 27,500 shares. The deal is valued at around about 13 crore rupees, and the promoters were the net sellers. They also made this announcement on the exchanges that they were sellers, sold around 2 lakh shares last week. Now, prior to this, Ramesh Damani did not have any stake earlier. Promoters had 75% stake before this most recent sale, and the mutual fund and FPI holdings remain negligible in John Cockerell. What retail, the smaller retail shareholders have around 15% stake in the company. Now, as of Friday, the stock was higher. The stock is up around 21% this year, down around 25% from its 52-week highs, but looks set to open higher in today's trade as well, courtesy this trigger.
Okay, all right. So we'll keep John Cockerell on our radar. It's doing really well in pre-open, 3.5% higher. The other stock in pre-open among our list, which is doing well, is Segal India on the big order win that they announced over the weekend. So watch for that as well. Okay, we are off now with a 50-point start at the open, 50-point positive. So it's looking good for the Nifty, and it's tracking level very close to 26,100 now. Gainers then, Hindalco with a gain of about 1.5%. BEL 0.7%. Remember, we need to watch for these defense stocks because the Defense Acquisition Council, in all likelihood, will meet today and they could consider acquisition proposals worth 80,000 crore rupees. Some of the defense names in focus. Coal India is the other one. There's some gain on Infosys, some gain on BEL. Actually, speaking of Infosys, we should pull up Coforge, see what Coforge is doing. It's very quiet. Coforge is it's flat, absolutely flat, unchanged. That's the reaction to that large deal from Coforge. More on it in just a bit. But back on the large cap screen, you've got Tata Steel, you've got Hindalco, so the metals pack is looking good. HDFC Bank is supporting the market. Titan is up about 0.3%. Lever is seeing a little bit of traction as well. On the flip side, the losers include Adani Ports, Ultratech Cement, Reliance is a little quiet, Reliance, Axis Bank, SBI, these are some of the names which are very quiet as of now. The 50-point gain has now reduced to about a 20-point gain on the Nifty. So, Rima, very range-bound at the start.
Mid-cap index also absolutely flat. MMTC, a stock that Hormus had highlighted for the kind of price and volume action it had on Friday, is seeing momentum on the way up. Seagull India, order wins boosting the stock in early trade. John Cockerell, up 6-7% yesterday. Ramesh Damani acquiring some stake, and that stock is also up 3.5%. Some buying seen in railway names that continues. RBNL, IRFC are up 2.5%. Once again, putting the spotlight on Coforge. Well, Coforge is down now 0.5%. Open absolutely flat, but now has given up the gains. It's a good asset, but as analysts are pointing out, it's also an expensive one. Timex is the other one where there was supposed to be this large offer for sale where the promoters were looking to sell their stake by nearly 9%. Not sure if the block deal has taken place, but Timex is weak in trade. Sigachi, I think, is one stock where there is some significant weakness. Sigachi is down close to about 4%. There was a fire in one of the units. The MD CEO was remanded on the back of this incident. So that stock is seeing some amount of pressure. PNB has reported frauds related to, I think, Shrey Infrastructure, that erstwhile account, and PNB is under pressure. Hindustan Copper up and about in trade. So this entire gold, silver, metal, base metal rally is boosting these commodity-related stocks. Hindustan Zinc now continues with the rally, 33% up in this month itself. And Manapura Muthoot Finance, the gold financiers, should also come up for you on your screen to see whether there is any kind of momentum visible in them. And all these ETF companies, Tata Silver ETF, HDFC Silver, Nippon India, Grow Silver, all of them bursting through the charts right now, Subi.
And you wonder why. It's silver up 160% this year. And no sign of the surge ending. By the way, you got a couple of views on the show today as well, right? People are still not calling for a short or a top on silver, expecting higher levels. And all those ETFs are up and about. By the way, MMTC is another one. So any play in the Indian equity space, that there's some kind of a play on either gold and silver, and those stocks are shooting through the roof. MMTC is up about 8%. And Hindustan Zinc, of course, like Rima mentioned, continues its forward march 1.5% higher. So what a move on the precious metal space. Well, with that, let's welcome in our market master of the day, Tahir Badshah, CIO of Invesco Mutual Fund, is joining in. Tahir, thanks so much for being with us. Season's greetings to you. Let me start by wishing you, very, very happy new year, the one that's about to come. Now, as far as 25 is concerned, I guess it was not entirely happy for equity investors. If people were diversified, had a fair amount of gold and silver in their portfolios, they're laughing all the way to the bank. But the equity underperformance really hurt. So let's start right there, Tahir. Realistically speaking, are you expecting the mid-cap and small-cap underperformance to reverse in 2026? If yes, why and by when? Tahir, I think you're on mute.
Sorry about that, Subi. Well, let me just start off by saying, wishing you all a very happy new year as well. To your question, so I think, mid caps at least have done reasonably well in the course of the year. Funds in many cases have actually outperformed the index as well. So at least the mid cap index has been able to return a positive outcome for calendar year 25 at about 6%. The real drag has basically been in the small cap space. And I think it is essentially to do with the fact that we've not really had a strong, micro or other growth outcome from, at least from the point of view of corporate earnings in calendar year 25. And there's a reasonably decent chance, though back-ended, that earnings will probably kind of, become a little more stronger during the course of 2026. compared to 25. I think it will, if that were to probably materialize, then there is a fair chance that small caps at least, which are meaningfully underperformed, the index itself is down about 6% for the year as a whole, can probably do better. But it will have to be a reasonably slow and gradual process. So I think it'll be more back-ended. Small caps do have a chance to come back, and especially if you have a broad-based economic recovery. That is what essentially drives small caps. So I would be relatively more hopeful of a small cap recovery coming about and more starting second half of 2026.
But do you expect a broad-based recovery to come through for the small cap index as well? Because at the headline level, everyone's expecting that we get back to say a 12-15% kind of an earnings growth. But will that be driven by particular stock sectors? Because just getting back to that point about the small cap underperformance, you need to see a broad-based NSE 500 kind of an earnings recovery.
Yeah, I think that probably is not entirely visible at this stage, at least when we evaluate earnings and look at all kinds of estimates on the street as well. When we build it up bottom up, at least as far as the nifty is concerned, then it will probably end up at about 13 to 15%. Estimates even go up to as high as 16-17% for FY27. But I would probably think that it is relatively easier to think about the narrower space or the narrower market at this stage. The broader market probably we will require quite a number of other things, more from a domestic standpoint as well as global standpoint, to fall into place. Tariffs as well as some of the domestic figures to start becoming a little more, a deeper or rather deepen into the system for a more broader based economic recovery to take place. So that is why, as I say, that it's going to be somewhat slow, somewhat more back ended. But given the fact that I've always noticed that small caps generally, when you buy them during pessimism, during times when they've not done well, during years when they've not performed, I think that generally tends to be a good starting point, and especially if you take a 2 or 3 year view out view, you usually tend to do reasonably well.
So, Tahir, on mid caps and small caps, I guess it's become a lot more selective. And I think the right fund managers with the right skill sets, I think they are the ones getting rewarded. Otherwise, just on a broader basis, while you spoke about this recovery, is it going to be very, very selective? Or can you at least play individual themes? Or will there be a lot of divergence within a sector, a small cap sector? I mean, for instance, I'll just give an example. Look at EMS, right? It was the sector that the whole market loved. Then it came under severe firing, lots of pressure. So do you expect a revival over there? I mean, similarly, renewables, so many other, micro sectors in the small cap arena. Can you name one or two that you think overall should do well in 26?
Well, I think, some of these things will depend upon how, even public investing actually, or public spending actually happens from the government side over a period of time. I think some of these themes which have been very, very strong over the last 2 years will probably go through still a little bit of pressure, I guess, over the near future. I think markets will probably rotate a little bit more into somewhat more defensive themes, which are probably driven more by consumption. I think that is where you will probably see a little more action, and that too in areas which are probably seeing underperformance. Maybe value retail to some extent will probably do well. I also think that it might be a decent time for some of the high-end retail also to make a comeback. That is where you are able to expect that spending power will probably once again resume, thanks to all the measures which have been undertaken by the RBI as well as the government. So I think some of these things are probably more likelier to play out as the market gains momentum. I think some of the themes which have played very well in the recent past, especially things like in the manufacturing area, etc., will probably take a little longer. I think defense still has a decent chance, because even if overall government allocations are a little muted, I think this will be one sector which will probably still merit a lot more attention from the government as well, given where geopolitics is. So I would think that this is then another theme which probably still, especially after this correction, can still have a decent chance to kind of come back. But I would be a little more skeptical about some of the others to come back very soon. I think hospitality and travel is something which can still do again, born out of it being relatively more non-discretionary in nature. And that is another area where we probably are still more positively inclined and reasonably well positioned.
So hospitality and travel, defense,
Consumption, parts of consumption is another area which should do well.
Okay.
And some of the industrials will probably be a little more back-ended. They will come back, but I also do not expect valuations in some of these which are to go back to their erstwhile peaks. I think it will probably now be returns which will be more in line with the earnings CAGR that they're able to probably generate.
Tahir, what is your own personal view on gold and silver? Is this a good time to buy an ETF linked to precious metals?
We are keeping our enthusiasm alive as far as gold and silver is concerned, and that is well reflected in our multi-asset allocation strategy, where we still continue to hold more like a 80% allocation, both gold and silver combined. I think at least my expectation is not of the kind of returns which have come about in the last year, but I'm equally surprised to see the kind of momentum that both of these still continue to maintain. At an aggregate level, what I can say is that we are keeping to this allocation that we have, and that should, in a way, give you an indication as to how bullish or bearish we are. But we keep rotating between the two asset classes as and when we find an opportunity, and rebalance within that 80% exposure that we have between gold and silver.
Any themes you're less bullish on compared to, say, 6 months ago because stocks have run up or earnings growth is likely to slow down?
So like as I said, manufacturing will probably take a little bit of while to recover because market is getting now retuned or readjusted to the possibility of large capex coming through and probably questions around execution as well and execution related challenges as well for some of these companies. And reassessment of the addressable market for some of these players. So I think that, like I said, will probably take a little more time to come through. And even if it were to, probably I'm not very sure if valuations will go to those extremes that we saw in the course of 24-25. I would like to think that even some of the consumer tech related entities will probably be a little more sober in the year to come compared to what they have been in the past. So there will be that regular rotation which comes about after a very strong performance of a couple of years. So there should be a fair bit of that coming through in 2026.
Mm-hmm. I was looking at some of those consumer tech names now, Tahir, as you speak. Swiggy is actually having a good morning. Let's pull up some of these stocks. Swiggy is up 3.5%. It's suddenly seeing a surge. It has company in the form of Zomato as well. So Eternal is up about 1%. That's an interesting move on both of the food tech, food delivery, consumer tech companies that we're talking about. The other space is really metals. Anything and everything in metals, even remotely connected to metals is going higher. Look at SAIL. SAIL is now surging 5%. Hindustan Copper has cooled off. It started with a 10% surge. Now it's about a 5% up move on Hindustan Copper, 6% actually on Hindustan Copper. Graphite India and HEG, they are up and about. I was speaking about MMTC earlier, the PSU giant, which is a play on some of the precious metals. There's also Mishra Dhatu, by the way, Mishra Dhatu Midhani, up about 5-6%. So like I said, anything and everything that has any remote connection to metals, precious metals, base metals, doesn't matter. All of them up and about. That's a green looking metal screen. So, Tahir, to expand that point on gold and silver, and I guess people have really opted for the multi-asset funds, right? And they're still piling on the ETFs. A lot of FOMO that's also playing out. But beyond the precious metal space, we've seen a rally in a lot of base metals as well. So, are you positively inclined on metals as an overall view? Or is this just a trading move that you have to maybe, play on the upside?
So we've not really been able to justify, at least some of the spaces in the metal space aside of precious metals based on fundamentals. To that extent, our exposures out there are relatively low. But I would like to think that there is more of the dollar weakness which is right now playing through in many of these names, and the fact that the precious metal side has rallied a fair bit. So there is a certain amount of catch up which is happening on the other side. we have yet to kind of be able to assign a lot of fundamental value to some of these names in the metal space, and therefore our presence out there is relatively limited.
Okay. So, Tahir, to sum it up, what's your big call for 2026 and the big advice to investors?
So, look, I think it is, to my mind, I think it is still going to be a year where rotation between asset classes is going to be reasonably heavy. We've been seeing that over 2025 and a little prior to that as well. I think much of that trend continues. So we'll have to be agile. I think, therefore, to that extent, find extremes in certain areas, certain sectors, certain fund structures, certain market cap segments. So, like as I said, small cap at one level probably could do well. Especially if you take a somewhat longer view, you could probably play for the recovery of earnings through the large and mid-cap space in the course of 2026. I think you will probably get a chance to rotate out of, let's say, foreign equities to domestic equities, maybe even at some level, if you continue to see strong rally in gold and silver, maybe rotate a little bit out of that as well, and try and increase positions in domestic equities over a period of time. So some of that rebalancing is what I probably expect is going to dominate most of 2026.
Okay, all right. Interesting view. Thank you for that, Tahir. And we hope to, of course, connect with you again in the new year. Season's greetings and wish you, your teams, and all at home a fabulous 2026. Thank you for joining.
Thank you.
Okay, well, with that, it's time to move on to some more corporate conversations. Before we do that, quick check on the market. Market's cooling off, by the way. We started with a 50-point pop, then it became about 25 points, and now it's just, kind of muddling along, 15 points on the Nifty. So as promised, let's get more corporate conversations going. Gulf Oil Lubricants is in focus. Now, there's been a large transaction in the global lubricant space. BP has sold off a 65% stake in Castrol to Stonepeak. And we want to understand whether that gives us any more clues about the lubricant market here in India. How should we read such a large global transaction? And, how Gulf Oil looks at the India opportunity. Ravi Chawla, MD and CEO of Gulf Oil Lubricants, is with us. Thank you for joining us, Ms. Chawla. Season's greetings. So, of course, 3 key talking points. I just want to run our viewers through that. Of course, we want to get your take on the global perspective, this large global deal, and how we should understand it. Your own levers for growth, looking at the Indian market here. And, of course, the strategic roadmap ahead for Gulf Oil Lubricants. So, Mr. Chawla, let's start right there. What a big transaction. BP selling off Castrol, and obviously the Indian listed entity, there's a transaction that's underway, the open offer that got triggered. But how should we read it? I mean, is the lubricant market not as attractive for large global energy players? Is it becoming a more niche market? Just give us your view on the transaction and the read-through for investors here in India.
Yeah, so Happy New Year to you and the viewers. Well, of course, we all are hearing about the transaction. I think it just signals that it is a growth element in India. For sure, the lubricant market is the 3rd largest market, growing the fastest. And I think globally also the market has its attractiveness. As you know, the core ICE vehicles are intact and the EV is also coming in. So I think overall it's an opportunistic market for us, for India especially. So I think it's a good place to be in. And yeah, this transaction, obviously we have to wait and watch what happens. But we always look at the opportunities, and India is well poised with its economy and other things. So I think it augurs well. And of course, big corporates take decisions based on their own needs. So that's something which is obviously happening.
But Mr. Chawla, I mean, I understand this was a global transaction, so structured very differently. But does this mean that at some point, and Gulf Oil has exhibited really good growth in this year as well, I think 15% volume growth. So does it mean that your commitment to the India market remains absolutely rock steady? Would you look at more organic growth here? Would you look at inorganic growth, acquisition opportunities if they come up along the way?
Well, you have to, obviously you have to watch what's happening, and we look at competition in many dimensions. And we basically are focused on our market, and we continue to invest in it, both in terms of our distribution, brand partnerships. So I think we are very focused on that, and we are also a global player. So if there are opportunities, obviously one will look at. But, the good thing is that there is excellent consumption of lubricants, and more high-end lubricants also coming in. So I think both these augure well for in India and overseas for us.
But as of now, are you looking at any form of an inorganic growth opportunity through assets, brand, or distribution?
Well, we embarked on some investments in the EV space, as you're aware, in terms of chargers, and we would definitely look at some opportunities. We're looking at a lot of industrial lubricants coming in. So I guess opportunities are always available. We have the cash here. We also look at opportunities, around our current operations. So I think that's always on the cards. And we'll have to wait and watch. And as I said, we continue growing in our own strategies, and we have market shares which are still below 5% in some segments. So we see that both geographically and segment-wise to be a great opportunity in itself.
So on the EV subsidiary, you recently increased your stake to 65%. Would you be looking to further increase it?
Well, we are working very closely with the founders, and I think that's the strength of having them. They've been in the market for a few years and have a 10% market share. So we continue working with them, and the key founders are still owning the rest of the 35% odd. And there is obviously adding value together. We're looking at that. So at the moment, yeah, this is what it is, and we want to continue. 1 out of 4 buses we believe has our chargers, so EV buses. So we want to really expand both into AC/DC chargers. And right now, yeah, we are looking at increasing capacities for our chargers also.
Got that. And tell me about the other white spaces that you would be looking to expand, get into, either on your own or via acquisitions.
Well, you see, in lubricants, we have all the products in automotive industrial. So we don't have we have a global R&D center here in India itself. So we have a lot of space there in terms of our market share, as I explained, in industrial lubricants, in areas like the infrastructure segment. Even in our B2C Bazaar market, we have geographically a lot of opportunities. So we'll continue looking at these opportunities. A lot of the markets like the passenger car and motor oils, we have less than 5% market share. In basically diesel engine oil and motorcycle, we are close to double digit. But for us, it's an all-round opportunity. And as we've been growing 2 to 3x the market, we're also seeing the market is growing well. Rural is growing now. Penetration of vehicles is going up as India goes into obviously more affordability. Rural sector is again doing well. So I think for us, it's also looking at our own expansion. Our brand is in the top 2, 3. So we want to increase our distribution. We've got excellent OEM partnerships. So I think all around for us, it's more working harder and working smarter in the market.
This INR depreciation impacted you all in Q2, but there has been a further depreciation even in Q3. What should we expect on margins? And is there a risk to 14% margins for the full year because of INR depreciation?
Yeah, so you're right. While crude is soft and steady, that is good for us. The INR depreciation has been close to 6% last 9 months. And I think that has really created some pressure. So we do have price increases, minor price increases we are taking. And I think for us, the 12 to 14% band is what we want to protect. Ideally, we'd like to move up. So hopefully we can see the exchange rate coming a bit steady. And then next year we can work on that. But I think for us, the band 12 to 14 is what we've indicated. And we're also trying to launch a lot of premium products. Recently launched a full motorcycle range called Syntrack. We're also looking at segments where we can add more value with our products. So I think it's a journey. And as we've indicated, yes, this exchange rate has been a challenge in the last 9 months.
I think you import about 70 to 80% of your base oil. So the exchange, the forex depreciation of 6% does hurt. But you're confident about maintaining margins of 12 to 14%, at least for FY26. But the goal thereafter is to further increase the margins with some premium offering. So say 3 years down the line, what is the margin that you're targeting, the margin range?
Well, it's a very competitive field, and we have the different segments which we obviously want to gain market share. So as I mentioned, definitely we want to move up to the 14 to 16. We are going to be watching obviously what happens in the market, and with our positioning, we are quite confident that we can improve the margins.
And by when do you think, Ravi, you can get to 14 to 16% margins?
Yeah, we are trying. I think this time the exchange rate obviously had an impact. So some of the controllables are with us, some are not. But we are pretty confident that with our products, etc., we would be able to take it in the much higher than what it is today.
Got it. And how much of the impact because of rupee depreciation have you been able to pass on via price hikes? Because as you said, it's a competitive market.
Yeah, so we have price variation clause with our OEMs. We have a large base of more than 40 OEMs. So that happens in the next quarter. And then we have also taken some price increases in the B2C, some of the segments. So I think it's getting passed on, but obviously we would like to have that go on in a faster way, and hopefully the exchange rate will stabilize, and that will help us to improve our margins, because the new products will take time to get accepted and obviously distributed. So that takes a couple of quarters.
So price hikes are fully passed on, or they will be by Q4 end?
Yeah, so we've been kind of looking at the competitive scenario. So part of it has gone through. Some of the products, obviously there is competition. So I think there would be a partial sort of rollout of it, and for the bigger customers, we would see the next quarter where the PVCs come in.
And what's the extent of the price hike on a blended basis?
So it's a couple of rupees, not a major one, but it's kind of trying to stabilize on the exchange rate impact.
You were just telling us about how the core business itself is seeing very strong innate demand. The rural market is picking up, B2C, etc. Now, you've spoken about high single digit to low double digit volume growth for the core lubricant market in FY26. Is that on track, or do you think you can do better? What is the volume growth that you foresee for FY26?
Yeah, so we have done about 10% growth in volumes, core volumes of lubricants. I think Q2 was about 9.5. So I would say that it would be around this percentage. Of course, we are seeing that we had a good agri season that came in this quarter that may not be there in the fourth quarter. So I think market will grow about 3.5, 4%. We would do at least 2x that in the coming quarter. And that's been our sort of push in terms of our segments. And we're also seeing the OEM piece do very well. So I think if market grows 3.5%, we should at least do about 8-9% growth. Hopefully try to always do better, but I think that's where probably the outlook would be looked at this stage.
Thank you, Ravi, for joining in. Wish you, your family, and the entire team at Gulf Oil Lubricants a very happy New Year. Well, that's the word coming in from the company. Very confident and committed to the India business. Margins will be maintained between 12 to 14% for this year, despite the INR depreciation. But the company is hopeful of expanding the margin range and increasing it to 14 to 16% for the full year. The company is looking at volumes of 8, 9, 10% kind of, nearly 2x of that of the industry, which is likely to grow 3 to 4%. Get into a break. On the other side, we'll invite the management of Vikran Engineering, which has been winning a lot of orders. So we'll get chatting with Rakesh Markhedkar. Welcome back. EPC major Vikran Engineering is the next management on the show. The company bagged 2 large orders in the week gone by in the solar EPC space. One from NTPC Green, and the other, there were multiple solar EPC projects in Maharashtra. Rakesh Markhedkar, CMD of Vikran Engineering, is now joining us on the show. And the 3 talking points are the H2 FY26 order win target, water segment, the exposure and the trends, and what's in store for calendar year 2026. So let's begin first with the solar EPC segment, where the company has won a lot of orders. Thank you very much, Mr. Markhedkar, for joining in. Almost at the end of Q3, what has been the overall order win accretion in the current quarter? What does your order book stand at? And what is in the pipeline in terms of future orders, say for Q4?
Good morning to you and Happy New Year to
Happy New Year.
And entire CNBC-TV18. So we have in a very good position as far as the order book is concerned now. We were getting very continuously inquiring for the new projects in the T&D and solar. But if you remember that discussion during IPO and post-IPO also, I was saying now with this IPO, we'll be very confident of booking the order and confidently we can move forward. So we are sitting today as on today, 29th of December, an executed order book of approximately 5,000 crores. And apart from this, we have a very clear-cut visibility for the very near future, around 2,000 crores of the new orders. So this is a really very boost to our confidence, and accordingly we have the improved, and we have strengthened our execution team, execution capability, design engineering team, and we are very confident. So that when we start a new financial year and on 1st of April, our unexecuted order book will be around 5,500 to 5,700 crores that time.
Okay. So 5,000, almost 5,700 crores. That
Yes,
is
please.
how your order book will look by the time you end this year. And are you ready
Very
for FY27? Got that, Mr. Marketkar. So give us a little more color. I think the bulk of this order book comes in from the power segment. And that's where you won a lot of your recent contracts as well. There is a little bit, that's the water segment, and then you also do work for railways. So what is the current breakup? This 5,700 crores, what will be the breakup? And in water, the reason I want to get to water as well, because some of the other companies that we speak to, they've been, citing delays, payment delays from not so much the central government, but from state government. So what's your expectation?
So that is very precisely. Let me come back to the breakup first of all. We have a 60% on pure solar plus T&D Act and 30% pure T&D. So put together, power is showing approximately 90%. This also includes 1 to 2% of railway only. Whereas we are limiting ourselves to 10% for the water. And for the last 18 months, we have not booked any order in the water segment. And though there is a improvement in the payment receipt for the water segment also, we are limiting ourselves to only the 3 states, UP, Madhya Pradesh and Chhattisgarh. MP and Chhattisgarh, there is absolutely no problem in receiving the payments. But in the UP, there was issue in between, but I believe now that has started resolving. So we are started getting. Anyway, but we are very strong in the power T&D, and now we are completely focusing on the complete package of solar plus BESS, battery storage and energy storage, plus the evacuation, that is substation and transmission line. So now we have strengthened the complete power, solar plus evacuation plus BESS package. And this has a huge market potential, not only in the India. Now we are also looking for African countries and Middle East. And we have started working very strongly in that areas too.
So how are margins? Understood your point that you're not looking to grow the water business too much. Probably stays limited to 10% of your order book.
Very right, very right.
So for the power segment, I mean, and these are very exciting segments, right? The battery energy storage systems, then of course solar. Your margins as of the second quarter were around 14.5%. So as this mix, kind of changes as you keep executing, is there scope to increase margins? And are the African markets more lucrative from a margin perspective? Are they similar to India?
Yes. As coming to that, let me comment with H1 our results. If you compare YOY, our H1 result has shown a big improvement. Like PAT has improved to 133%, revenue improved to 13.6%, EBITDA margin is improved to 81%. Because when we have the business cycle is such that our major revenue comes in the second half. Because we were limiting our order book and we were maintaining a very fair balance between order book execution and working capital availability. So we used to be very careful while booking the order. Now, since after this IPO, since we have money work, and that the whole purpose of IPO was for the working capital, so we are very confidently moving. And now that next financial year onwards, you will find a fair balance between the Q1, Q2, Q3, Q4. So, and at the same time, we will be continuously improving in the quarterly results as well.
So where will you end the year, sir? Let's understand this. You told us by the end of the year, you'll probably close with an order book of 5,700 crores.
Yeah,
where
5,500 to...
5,500 to 5,700.
Correct.
This on the top line and margins, just give us estimated top line by the end of the year and the EBITDA margin by the end of the year.
So end of year, we will be around 1,400 to 1,600 approximately range. And this will be the huge improvement over the previous year. And I am happy because the current order book, very clear visibility, we have the EBITDA margin, will be approximately in the same 16.5% to 17.5% EBITDA margin range.
Okay, I thought H1 margins were lower at about 14-15%.
That was in H1.
H1.
Because H1 margins are our comparatively low. But when we see the overall, so then overall for the financial year, we maintain our margins.
And in this top line, estimated top line of 1,400 to 1,600 crore, what will be the contribution of solar EPC? Because many of these orders are just recently won and they will take time to ramp up.
Yeah, so but the overall, if we see around power will be approximately 75%, and that solar will be around 40% of total power. But for the next financial year, solar will be the big brother in our case.
And what will the contribution of solar EPC go up from the current 40% to top line this year?
Yeah.
Next year, what could that number stand at?
Next year, it will be approximately, the solar alone will be 60%.
So from a margin profile perspective, this is the last question from my side. You said that your margins will improve to maybe as much as 17% by the time this year ends. So from a margin profile perspective, between BESS, solar, the evacuation, the T&D side, which is the most lucrative for you? And again, I go back to that question between India and Africa. Which market is more, which segment in power, and which geographically, which market fetches you higher margins?
In organization, we have maintained very well financial discipline to maintain the intake itself is the profitable projects. So our mostly all the project, whether it's the T&D, the 765 kV power grid substations project, or this solar project, we have approximately the same margin range. And whatever we had given the, if you see EBIT margin of my last 3 financial year, it was 15.5, 16.5, and 17.5. So we are booking our orders in the same fashion. Coming to the overseas market, the currently African project, what we have quoted good projects now. And I'm very happy to say with a better margin, this is what we are currently saying.
Okay, Mr. Marketka, we leave the conversation here. Thank you very much for joining in. You've shared a lot of numbers with us. Yeah. FY26 top line growth, 1,400 to 1,600 crore, margins of 16.5 to 17%. Order book stands at 5,000 crore, visibility of 2,000 crore. And as they begin FY27, the order book should be close to 5,500 to 5,700 crores. That's Vikrant Engineering, and stock has spiked up. But for the market, still very range bound and still consolidating. This would be the 4th consecutive session now of market consolidation. Siddharth Rai Mangla of Stockbox Technology is now joining in. Siddharth, the range continues. The Nifty is just up close to about 20 odd points. Bank Nifty down a tad bit. What's the trade?
Hi, Rima. Good morning. See, Rima, if we talk about Nifty, first of all, even after Nifty has faced some pressure on the higher levels, it has still managed to take support at the 26,000 level. So, this is a very good thing for the index. The overall structure in Nifty still looks strong. But having said that, Rima, for the past 3-4 sessions, we are clearly seeing volumes going down, and there is very lack of interest in the index. So no fresh opportunities to buy a fresh momentum opportunities to buy in Nifty are not showing up even now. So it is much better to sit on the sidelines. Even though somebody has an existing long position in the index, they can definitely keep on holding on to them with stop losses around 25,950. But for fresh long positions, this is not a time to take fresh long positions in the index. We can definitely go stock specific in this time, because there definitely we are seeing some momentum in few selected opportunities.
Okay, so let's talk about those opportunities, Sid. Which stocks are you going with?
Sure. Hi. So we see 2 stocks. Both of these we have to buy. The first one is from the metal space, which is clearly buzzing right now. The stock's name is Steel Authority of India, SAIL. Today we have seen a very big breakout in this counter, and also we are seeing an open low being made. The stock started running just from the level where it opened. So the structure is very strong. This momentum should definitely continue from here. So SAIL can be bought right now. The spot is trading around 137.7-ish. The stop loss will be at 135, and our targets being the first target 142 and the second target 144. The second stock is from the FMCG space, and the name is VBL, Varun Beverages. This stock was in a consolidation for the past 1 month, And now in today's sessions with a very strong up move, we are seeing a very nice breakout in this counter. I will probably be seeing this going above 500 in very little time. So Varun beverages can also be bought. Right now the spot is trading around 492.5. It can be bought here. The stop loss will be at 480, and our targets being above 500. Just like I said, the first target being 510, the second target being 525.
Okay. All right, Siddharth, thanks for that. We'll leave it on that note. By the way, the market has really fizzled out. Nifty is barely positive now, just about 12-13 points. Bank Nifty is flashing a little tinge of red at this juncture. So, yeah, I mean, gains are not really intact. On the banking side, look at Axis Bank. That's a bit of a drag. SBI is down 0.25% as well. ICICI Bank slightly lower. And even the non-banks, a lot of the non-bank stocks very sluggish this morning. Shriram Finance, Geo Financial, HDFC Life, plenty of non-banks, all on the red side of the screen.
Railways are also correcting. So after the heady
Friday
rally
move,
of Friday, today you are seeing down about 2.5%. IRFC 2.5% lower. RVNL, Ircon also down close to about 1.5%.
Yeah, absolutely. Only metals. It's metals all the way. It's those stocks that are continuing to pile on the gains. Tata Steel, JSW Steel are your nifty winners.
And those quick commerce companies.
Eternal and Swiggy.
Eternal and Swiggy also seeing some buying. In fact, there was some news report about gig companies considering a strike. So a lot of these delivery guys on 31st of December, which is the peak period. So I guess you're not going to get your orders if that comes to pass.
Home food. For New Year's.
But stocks are unperturbed. There is still gain of about 1 to 2% leading over there. But there is that news about gig workers, again citing just poor working conditions, etc. So they're looking at a strike, 31st December.
All right. Well, with that, let's actually shift focus to the large trade that has been in focus. This is Timex. Now, the stock has been under pressure because the promoter entity is believed to be looking to sell out. We have Vivek joining in. Vivek, what more on the trade now?
Well, that's right. Last trade, or you could actually call it an offer for sale. So, you'll actually be able to go ahead and bid for this particular deal at the floor price or at a price above which you feel is actually the fair value as well. So, let's have a look at what has actually transpired as far as Timex is concerned since June of 2025, where remember at the end of FY25, the promoter Timex Group Luxury Watches BV actually held close to 75% stake, that is 74.9% stake. June 2025, remember at 175 rupees a share floor price, they actually went ahead and trimmed close to 15% stake. Again, the route that they chose was the OFS route. Now at the end of Q2 FY25, they had close to 59.93% stake. And once again now, despite the large overhang of promoter stake sale, the stock price actually has appreciated quite significantly. And in fact, the current OFS for close to 9% is at 100 rupees higher at close to 275 rupees a share. Just having a look at the financials of the company, this particular year has been quite strong as far as Timex is concerned. Revenues in Q2 jumped by 40%, EBITDA higher significantly by 70%, margins almost 300 basis points improvement, and profitability higher by 70%. H1-2 has been quite strong, that partially explains the kind of stock price movement that you've seen. Revenues higher by 45%, EBITDA more than doubling, margins also expanding close to 450 basis points, and profitability more than doubling on a year-on-year basis. In terms of the stock performance, Timex actually has given almost an 80% return in this particular calendar year itself, and from the previous OFS to the current OFS, up by over 60%. So despite the kind of overhang you've seen in terms of higher float, you've actually seen a significant outperformance coming by from Timex.
Thank you very much for that. And now over to Hormuz for John Cockrell, which is gaining in trade.
Doing well is John Cockrell. Second straight day of gains now, following up that 6.5% up move last Friday, up another 4% in today's session. Veteran investor Ramesh Damani buying stake in the company, close to around 27,500 shares that he acquired. The deal transaction of around 13 odd crore rupees. What does the company do? Well, it is an industrial components manufacturing company. It is involved in the developing technologies for cold rolling milk complexes, processing lines, and a lot of other such things. And in that stake that Ramesh Damani bought on Friday, promoters were the net sellers in that transaction that took place. They sold close to 2 lakh shares as they announced to the exchanges as well. Now, John Cockrell, as of September, The promoters had 75% stake before this most recent sale. There's a very negligible mutual fund and FPI stake in the company as well, and a majority of the remainder of that stake is owned by small retail shareholders of close to 16%. Now, as of now, with that stock was up 6% on Friday, up 4% today. So it's trimmed some of its year-to-date, extended its year-to-date gains to 25% and trimmed some of its losses from that 52-week high, which was in excess of 6,600 rupees, now down around 20% from those levels.
Thank you very much for that. Get into break on the other side. Manisha Gupta will focus on the commodity space. It's all happening over there, so stay tuned for that. Welcome back. It's time now to talk about silver and the record-breaking rally that we're seeing. Manisha is now joining in. Manisha.
Oh, well, absolutely. It's been a silver lining to 2025 with the kind of gains that we've seen for this one. And we already knew from the beginning of 2025 that we are headed towards an all-time high. But the kind of levels and the numbers that we are working with is something that absolutely nobody got right. So $80 an ounce is where we are trading. $81 is an all-time high, so not too far away from that. We started Asia with 75 on the lower side, but as we've been talking about in silver, every dip is getting bought into. So we are 170% up for the silver prices in this year till time. This is the best annual gain that you've seen since 1979 for silver, and everybody that you talk to seems to be buying silver right now. I want to take you through a chart on what we've done this year. We started this year with $29 an ounce. 35 was crossed in June. So between Jan and June, which is 6 months, silver did not do too much. But once that 35 mark was taken, it was in the month of September that we saw 45 takeaway as well. So $45 an ounce was the highest level that silver saw since 2011. October did 50, which is an all-time high for silver. And then take a look at what we've done in the month of December. 56 is where the silver was on the 1st of December, and 81 is where we are standing right now. So that $30 of a jump up has come in only in the month of December alone. Very, very strong gains coming in on the back of very strong buying. Remember, it is the uses that silver has found more and more in 2025. Whether it has been about electrification, solar power panels, EVs, data centers, electronics, everywhere silver is used. And then it is about the dislocation in the international inventories. There's a lot of silver on ground staying in US, but not so much in Asia, in Shanghai and in London, and that's bothering the prices there. US is talking about putting silver in critical mineral list as it is a national security risk. The US Commerce Department probe is expected to bring out the result by the mid of Jan. And if silver actually is part of that, then you could be looking at silver prices surging even higher from here on. $100 an ounce is what everybody seems to be talking about by the end of June itself. The ETF inflows have been the highest since 2020 in the Indian markets, and this year we are to the northwards of 3,500 tons of silver bought by the way of ETFs, and there is physical silver backing it. You have very heavy speculative moves on paper. On ground, not so much buying, but on paper, there's very strong moves coming in. The physical investment buying in India in this year has been to the tune of 2,000 tons. That's the amount of silver people bought in physical forms and bars and coins, etc. And it's not just about silver. Take a look at platinum prices. We're trading at record highs onto this one as well. $2,500 an ounce. We started this year with $950 an ounce. So from $950 to $2,500 is up by nearly 176% coming in for platinum as well. It is about strong demand coming in from automotive, jewelry sectors, etc. It also is about the longest winning streak that platinum has seen since 2017. Also, it is closing 2025 as the biggest annual gain. 176% of gain is something platinum has never ever done before. Interestingly, the European Union also did a U-turn when it came about 2035 combustion engine ban. So now that date is off. So that means platinum demand will continue to be very strong. Get gold on your screens, and we've seen $45, $50 an ounce of an all-time high. It's seeing a bit of a profit taking right now because the last week was very, very strong gains therein. This is also the strongest gain we've seen since 1979. Gold is up 71.5% in this year. This is once in a lifetime kind of an opportunity that we are seeing in gold and silver and platinum. In 1 year, all the precious metals have surged so strongly. Central bank buying has been a major pillar here, and 800 to 900 tons of gold buying is what you could be looking at in this year as well.
And then the ETF inflows has been the highest in 5 years. So when you look at those numbers there, the gold ETF inflows stand at around $82 billion, which is almost as high as equivalent to around 749 tons that we've seen in this year itself. And the last one on my screen should be on copper, because this is the fourth metal that also has seen an all-time high. On CME at 5.9 and on LME $12,000 to $80 a ton is where we are trading. This is after the US president pledged to put duties on commodity-grade copper by next year. Remember, there already is a 50% duty on semi-finished copper products. So a lot of copper has been brought into US by paying a premium as high as $500 a ton as well. So this is another case of dislocation, really, because there's a lot of copper in US, but the rest of the world clearly dealing with a shortage there. And then there are output concerns in Chile, Peru, Indonesia. There's lower output guidance from miners. We haven't seen lower output from miners in this year, but this is the forward guidance that already had led the sentiment on the higher side. And that is the reason you'll have a lot of people buying in case of copper right now. Also, when you look at the forward projects, there are not too many of that supporting copper prices, with an expectation that 2026 could be looking at higher highs for all of these metals.
Okay, all right. Metals, shining bright, whichever ones you're looking at. Thank you, Manisha, for that wrap up. We'll take a break on that note, come back on the other side, and we'll focus on Coforge's mega Encora acquisition. We'll have more perspective coming in from Bhavin Shah and Sandeep Agarwal. Okay, well, let's put the spotlight on the big deal that was announced over the weekend. Coforge has pulled off its boldest move yet. As CNBC-TV18 reported, it has agreed to acquire Encore, creating a combined entity with which is valued at $2.35 billion in revenue and ambitions to play in the big league of AI, product engineering, and cloud-led services. The deal is unquestionably big and strategic. But the question is Coforge paying too much? Let's go across to Rima for all the details on this mega transaction. Rima.
Thanks so much for that. I think that is the big question everyone is asking. Is this deal between Coforge and Encora expensive? Well, the short answer is it's a good asset, a great asset, but perhaps a tad bit expensive. Now, Coforge is paying $2.35 billion for Encora. This is a company with estimated revenues of $600 million, which means the acquisition is being done at an EV to sales of 3.9 times. Now, putting that in context, most global digital engineering companies today are trading in lower multiples. Now, this I picked up from a Motilal Oswal report where they're saying a company like EPAM is trading at 2 times sale. Globant is trading closer to 1.3 times. And even some of the recent M&A deals were cheaper. Now, Cognizant acquired Belcan last year at roughly 1.6 times EV to sale. Infosys bought Intech at about 2.6 times sales, which raises the valid question, has Coforge paid a premium? Especially when you see it in context, analysts point out, to Encora's organic growth, which is slow to 7 to 8%, while Coforge itself has been growing much faster at mid-teens. Now, JM Financial summarizes by saying the valuation looks rich given Encora's 7 to 10% growth profile. Now, moving on, when the price is high, there is also very little room for error. So what are the risks? Well, I can see 3 of them. One is integration risk, because this is a very large acquisition, the largest done by an Indian company. Encora is more than 30% of Coforge's size compared to their earlier deals like SLK Signity, which were smaller. So when there is such a large asset, integration is not the easiest. Secondly, the management is also guided for the acquisition being EPS accretive by FY27, but this requires flawless execution. The second risk is dilution risk. It's an all-stock deal leading to 21.25% equity dilution for the existing shareholders. And on top of that, Coforge has the option to raise an additional $550 million via QIP to retire the debt As of now, it's not decided by the management whether they will flex that option, but it's still an overhang. And the third one is the overhang from private equity investors. Encora shareholders will hold about a 21 to 22% stake in Coforge, and 50% of this will unlock after 6 months, the remaining after 12 months. Analysts say that this is a potential supply which will cap the near term. But it's not all negative. There are some real positives here. Now, post-deal, Coforge becomes a $2.5 billion revenue company with EBIT margins of close to about 14%. The management is calling this a defining moment in Coforge's journey, and there is a clear step change in the company's capability. Encora brings AI-led product engineering, and the combined company will have nearly $2 billion of AI-linked revenue. The deal also opens up high-growth white spaces for the company like high-tech and healthcare, and the revenue synergy potential is significant, especially through cross-selling, and Coforge does have a very strong execution and an M&A track record, which gives the street some comfort. From a stock perspective, just over the last couple of days, the stock had declined close to about 10%. So some of the concerns are being addressed. But other than that, it's been such a wealth creator. Its 3-year revenue run rate is, the stock price return is 120%. In the last 5 years, it's more than 1,000%. So it's a bold, transformational acquisition by Coforge, and now it's up to them to deliver on that.
Okay, indeed, a bold, transformational deal as well. Can they walk the talk? And can they really, create that scale and value? That is the big question. Let's actually discuss this with our next set of guests. We have Sandeep Agarwal, fund manager at Solio Investment Managers, joining in. In a bit, we'll have Bhavin Shah of Aquarius also with us. Sandeep, let me get your first take. We were speaking with Moshe Katria earlier on the show, and one really wonders whether this is going to be an acquisition really worth paying for. Your thoughts?
Hi, good morning, and thanks for having me on the show. So, I believe that you have to do strategic things, and from that perspective, Coforge has probably gone and done this, but there is very limited story of successes in such kind of acquisition, particularly as Rima mentioned, the integration risk, the execution risk are too high. One good thing in the deal is obviously it is an all-stock deal, so everyone's outcomes are completely connected. So I think from that perspective it is very good. A really worrisome scenario would have been if they were paying cash by raising money through equity or debt. But yes, having said all that, and I believe that there is a merit in the argument that EPM and Globant, all of them, and the transactions which have happened at a much lower price. So at this price, when you are acquiring something, the onus on meticulous execution is very high, and also the margin of error is very low. So I think time will only tell how it can happen. But I can tell you that Coforge management, when I was a sell side analyst, I've interacted with a lot of time. They are very good. They are second to none. So I also have a lot of confidence in their execution capability.
Okay, so you seem to be sounding optimistic on the way the company has delivered in the past. We also have Bhavin joining into the conversation now. Bhavin, thanks for being with us. By the way, season's greetings to both of you. Thank you so much for taking out the time and being with us ahead of the new year. Lots of news flow. So Bhavin, what's your sense? We were speaking with analysts earlier who said that Encora is not really an AI native company, ground up AI company, but those companies maybe are just too expensive for an Indian company to acquire. So in that context, does Encora make sense for Coforge?
So I think, first of all, they're acquiring using stock, and using a very expensive stock. So, in some sense, it might just work. And the other thing is that, with a full tax on dividend and buyback both, I think companies are going to have less of an incentive to pay dividends or buyback, and, might use that cash for more acquisitions. So I think what we have seen in 2025, more of that might come in form of acquisitions.
So Sandeep, I think the question is, what does one, gentlemen, good morning. What does one do with this stock now? It may be a bit expensive, but the management has shown flawless execution in the past. Their track record is good. So would you bet on Coforge now with this acquisition under its belt? Both of you. Sandeep, go first, and then Bhavin.
See, we have a very clear view since last 12 to 18 months. We are very negative on the sector, so we don't hold any position nor intend to hold anything immediately because we believe another 12 months of pain is definitely there. I am very clear that if we buy something, we'll buy in ER&D space, but at a right price, the current prices, and we don't go by PE ratio because that is very misleading because the growth rates have fallen a lot. We go by PEG ratio, and on PEG ratio basis, the whole sector is super expensive, and we don't have the guts, don't have the policy, don't have the mindset to buy at this prices at all. Anything.
Bhavin, same question to you. Coforge has been a wealth creator, but from here on, given the integration-related challenges, do you think re-rating from here, generating exponential wealth is going to be difficult?
I mean, it's the second large acquisition in a very relatively short time, and I think I agree with the comments that it's a very expensive, stock. So and growth rates overall. I mean, obviously the companies like Coforge are growing at a faster pace than the large cap IT. But still, I think one has to be very careful with the valuations at this level. So I mean, I think one of the key metrics that we track is of cash flow yield. And we can look at operating cash flow yield if there is a big acquisition. But cash flow yield is also, operating cash flow yield is also very low.
So both of you, Coforge is an avoid as of now? Sandeep and Bhavin?
I won't comment on a stock specific thing, but I will say that I don't like anything in the sector.
Okay. Bhavin, Coforge is an avoid for now?
Yeah, I mean, we don't own it and we don't intend to buy it.
Got that.
Gentlemen, again, just to go back to the larger point on the way Indian IT services companies are trying to pivot towards AI and really, involve AI in most of their product offerings. So the large cap giants, which have these huge cash piles, they don't seem to be going the acquisition route at all. They are embedding AI in most of their, service offerings. TCS gave us a glimpse of what that might mean when they gave us a bit of a revenue indication. So do you think that pivot is progressing well or along expected lines, or is it too slow or too little? Sandeep?
No, so I think this is the only option which is there with the Indian IT services firm. And remember that, whatever people may speak right now, there is massive demand for the hardware. And I think hardware peak demand is behind. So these chips and all these companies have done phenomenally well. I don't know how long they will do well because hardware replacement cycle, in my opinion, is broadly over. Now the software companies will do phenomenally well. And then comes the turn of software services. The only challenge for us is that, there is a 30% cut in the effort, which has not happened in the past in any disruption. So when there is such a sharp cut in the effort itself, despite, you being the market leader and having 90-95% share in global sourcing and whatnot, but still, when your effort itself is going to get cut, I don't know how much you can grow and for how long. So that's the reason I believe that, our large cap IT companies are for a long period of time will be in 5-7% growth range on an average CAGR basis, and mid caps maybe 10-12%, the ones which are in ER&D, and the small cap may do better. So we are looking at the sector from that perspective. I don't see high growth coming in for the sector, for the large companies or the mid cap companies in next 2-3 years at least.
Bhavin, analyze the capabilities of Coforge now with this acquisition versus, say, the other IT companies now. Now, historically, it's always been Coforge and Persistent. These two were liked by investors. Now, how would Coforge's capabilities change post the acquisition, and how would it compare with, say, a Persistent?
Yeah, I mean, I think it's frankly, I haven't gone into that details for Coforge, this acquisition and capabilities. So, perhaps, maybe I'll skip that question.
Do you like, Sandeep's view is he doesn't like IT services company. If he has to buy, he'll buy maybe an ER&D company. But do you own anything in IT services in India right now?
Yes, I think we have spoken before. We own Infosys. I think we bought it, when it was below 1,500. And then I think we have seen a bit of a rally. We also have Mastech in our portfolio in the small cap space. And then we have IT-related companies like Reddington, for example, more into distribution. One of the recent listings, iValue Solutions. So we have a few names, having a relatively different type of business model, which has still got a bit of growth and valuation is reasonable.
Got that. How does this, do you feel the other IT companies, Sandeep, will now feel the pressure to go out there, acquire scale, show high growth numbers, because organically they're not generating growth? So do you think that we will see more acquisitions now by other IT companies? Large cap IT companies have already started, even a TCS. But will we see more from other companies to shore up growth numbers? Sandeep?
No, I don't think that will happen because, I have seen last 20, 25 years, Indian IT company managements are very, very, practical, and they know the situation, and they know this kind of, whenever this disruption happens, there will be lower growth and they have to tide through it. So I don't think they will do any acquisition due to pressure from anyone. But yes, if required, they will definitely go ahead and do. So I will say like this, that, Indian IT services management is top notch for all the companies. And that is the reason that, we have gained so much market share over the last few years. And that is the reason the financials have not got spoiled. We have tied through all the challenges from visa to whatnot. So I think management will not come under any pressure. I am pretty confident that, they will do the right things. And we have to accept that, in an industry, you see Accenture numbers for last 25 years, what kind of numbers they are giving, including organic, they are not able to grow at all. So we are doing far better than that. And this is a reality that, when you have so much penetration in a mature services, your growth expectation has to come down, because these are more stable than even, fixed deposit kind of return. You are making 4-5% dividend yield and all those things. So you have to also tone down your expectation of growth, and so are the multiples have to systematically come down. So I don't see any challenge. This is like any other industry which matures.
Okay. All right, gentlemen. The debate on Indian IT will continue. Thank you so much for joining in and giving us perspective on the discussion today. With that, it's time for us to wind down on this edition of Bazaar. Do stay tuned. Chartbusters coming up next.